panelists. So we have Cara Goldenberg and Kaja Rebane, and they are part of RMI's electricity team, where they work on utility business model reform. Cara is a principal who has worked closely with the Hawaiian Public Utility Commission on their PBR proceeding, as well as Connecticut's consumer advocates with their PBR proceeding. She also works with regulators, advocates, and other stakeholders on PBR topics in other states. Kaja is a senior associate who previously worked for Pacific Economics Group, a consulting firm which specializes in productivity benchmarking and PBR design. So certainly two experts there from RMI. And then, of course, Jacob Van Reen is a certified public accountant, and he is focused on the utility industry. He was previously a senior manager at Ernst & Young's forensic accounting practice. And prior to EY, Jake was an auditor with PricewaterhouseCoopers. Jake has assisted numerous regulatory commissions and utilities in rate case proceedings, regulatory investigations or inquiries, whistleblower investigations, program cost recovery proceedings, disputes, and litigation. So really excited for the experts to really enlighten us on this topic. And I'll turn it to our chair and today's moderator, Commissioner Anthony.
Yeah. Hi, everyone. Again, welcome to this meeting of the PBR working group. I'm so glad that you're all here and that you made time for this today. I think it's going to be a really fantastic presentation. I've seen the slides, and I'm really grateful the approach that for the approach that both of our presenters have taken, and just sort of laying out what TOTEX means. And I'm going to let them get started because I do have a lot of questions. So I think, Cara, are you going to go first?
Yes, I am. I'm just going to pull up our slides here. Okay, how does that look? Excellent. All right. Hello, all. It's great to be with you today. We're going to go through a presentation and discuss how TOTEX ratemaking can address utility Capex bias in the U.S. As Elliot just announced, my name is Cara Goldenberg. I'm a principal with RMI's Carbon-Free Electricity Program, and I'm joined today by my colleague Kaja Rebane. The two of us focus on utility business model reforms to accelerate the energy transition, and have recently published a report focused on the feasibility of implementing TOTEX ratemaking in the US. And so we are excited to be here to share some of those findings with you guys. So as for an agenda today, we are going to start off by providing some context on some of the major challenges confronting the electricity sector today, which you are all aware of, and including, we'll also define what we mean by utility Capex bias and how different regulatory solutions can address it. We'll then go on to describe specifically how TOTEX ratemaking works, and we'll share some findings from that research I just referenced, published last summer. We'll then hand it off to Jake for another presentation, and then we'll open it up for Q&A and discussion. But please do add any questions to chat, and we'll try to address them as we go if there's anything that needs to be clarified. So starting us off with the challenge ahead, as we are all very well aware, the United States stands on the cusp of a massive spending surge in the electric sector. To decarbonize, as well as to meet increasing load from electrifying buildings, transportation, and other sectors, we need significant investment in clean energy resources. And spending in the power sector is also even expected to increase due to the investments necessary to ensure resilience in the face of extreme weather events, to replace aging distribution infrastructure, and to modernize the grid. And to maintain affordability through this upcoming investment surge, it is critical that utility spending be cost-effective. This means that regulators should, of course, discourage unnecessary spending and also motivate utilities to select from the best solutions available. So to achieve that, though, all potential projects, whether they represent capital expenditures, also known as Capex, or operating expenses, also known as OpEx, should be on equal footing so that they can compete fairly against each other. However, the playing field as it is now is currently not level due to an issue known as Capex bias. And so, as you all know, Capex bias stems from the traditional cost of service regulation model for investor-owned utilities and how utilities' revenue requirements are established. And so I know this formula is very familiar to you, but just to quickly run through this so that we're all on the same page in terms of terminology. So Capex, right, is under the traditional cost of service model, added to the utility's rate base and depreciated over time. The utility is then allowed to earn a return for its shareholders on that undepreciated balance. In contrast, OpEx is quickly passed through to customers via rates. And since the utility is allowed to earn a return on that Capex that is higher than their true cost of capital, utilities can increase shareholder profits by increasing Capex. Thus, investor-owned utilities generally prefer capital projects like long-lasting infrastructure rather than OpEx alternatives like PPAs or energy efficiency, even if these alternatives are more cost-effective. And just to clarify, addressing Capex bias does not mean that utilities are going to stop asking to build big capital projects, right? We all know that utilities are going to need to continue to invest in infrastructure to support the clean energy transition. Addressing it, though, means that ensuring that utilities face equal incentives when considering both Capex and OpEx alternatives when available. And I just want to note here that while we focus on electric utilities in this presentation, as well as in our paper that we wrote, Capex bias is very much a concern for investor-owned gas utilities as well. So now I'm going to describe the different regulatory solutions being pursued to address Capex bias in different PBR frameworks today, and how TOTEX specifically fits in. So first off, taking a step back here, right, addressing Capex bias is one of the 4 major pillars of performance-based regulation. The other 3, as you can see here, include incentivizing cost efficiency, which is usually done with multi-year rate plans or perhaps performance incentive mechanisms, PIMs, removing the throughput incentive, which is usually accomplished through decoupling, incentivizing more targeted outcomes, right, which can be done using PIMs as well. And then lastly, we have equalizing Capex and OpEx incentives. And there are a number of tools that regulators have used to achieve this, some being more effective than others. So in the US, regulators have used a few different solutions here. So I'm going to walk through those. Some regulators have used OpEx capitalization to address Capex bias. So this is where regulators allow the utility to amortize a category of OpEx and lets the utility earn a return on it over time. Some regulators have used performance incentive mechanisms, which can attach a financial reward or penalty to a utility's performance in a specific category of OpEx, such as energy efficiency, which you see in a lot of states. Some regulators have used shared savings mechanisms like non-wires alternative shared savings mechanisms, which are essentially a type of PIM, but can allow the utility to retain a share of cost savings when it implements a cheaper alternative, which very well can be an OpEx solution. Some additional mechanisms here include modified clawback mechanisms. So clawback mechanisms can be used to reclaim budgeted but unspent Capex And a modified version of this can allow the utility to retain the difference between approved CapEx and actual OpEx until rates are reset. And then two additional mechanisms that haven't been implemented in the US thus far, but have been used in comprehensive PBR frameworks elsewhere include a calibrated efficiency carryover mechanism, or ECM. And these are used with multi-year rate plans to preserve the multi-year rate plan's cost containment incentive through its later years. And to address CapEx bias specifically, an ECM can be calibrated to equalize the CapEx and OpEx incentives. And then finally, we have here TOTEX Ratemaking, which removes the distinction between OpEx and CapEx for rate-making purposes. So as I said, all of these mechanisms, except the calibrated ECM and the TOTEX rate-making mechanism, have been adopted in the US in some form. However, the mechanisms that have been used in the US have been relatively narrow in scope. And so they've been limited in terms of the extent they have been able to address CapEx bias. On the other hand, a calibrated ECM as well as TOTEX ratemaking are much more comprehensive. And so they can address CapEx bias to a fuller extent in utility decision-making because they cover a much wider scope of utility costs. With that said, I will note that you can see that there in the bottom, that these mechanisms also could be implemented in a narrow fashion if needed or desired to gain familiarity and comfort with the approach, since they are still pretty novel here in the US. Happy to chat through that, what that could look like further in Q&A and discussion. But now I'm going to hand it off to my colleague, Kaja, who's going to walk us through how TOTEX ratemaking actually works.
Thanks, Cara. You can go on to the next slide. So as Cara already said, TOTEX ratemaking basically just treats CapEx and OpEx equivalently for ratemaking purposes. And by doing that, it really addresses the root cause of CapEx bias rather than kind of trying to, take a different step to counteract it or kind of put a Band-Aid over it or otherwise partially address it. It really gets at that root cause. And TOTEX ratemaking is one component of the UK's RIO framework, which is their comprehensive PBR framework, as I trust probably everybody on this call already knows. And it has also been adopted in Italy, specifically for smart meter expenditures to, as Cara said, kind of pilot its use there with the expectation it will be rolled out more broadly for energy utilities. Now, in this diagram, you can see how TOTEX ratemaking differs from the traditional cost of service framework. So I'm going to walk through step by step how this works, and certainly if there's any clarifying questions, I'd be happy to take them so we're all on the same page moving forward. So first off, CapEx and OpEx are combined into total expenditures, or TOTEX for short, as Elliot said. So you basically take these two separate categories of costs and you combine them into a TOTEX construct, and then you reapportion them out based on something called the capitalization rate, which I'll talk about in a second, into two new pots of money. One is called slow money, and slow money basically just functions like CapEx does in the traditional revenue requirement formula. It gets added to rate base. It is depreciated over time, and the utility is able to earn a return on the undepreciated balance. And then fast money functions like OpEx does traditionally. It's passed through pretty quickly to customers, and so the utility is not able to earn any substantive return on it. A couple of notes on this figure before I loop back to the capitalization rate. There's a box called adjustments there at the bottom. In the RIO framework, there are several things that are handled outside of this TOTEX formula. For instance, what's known as uncontrollable expenditures. So you'll see at the top, there's a little thing that says controllable expenditures attached to the CapEx and OpEx. And that's because really the point of TOTEX rate making is to encourage the utility to make better decisions when deciding between CapEx and OpEx projects. And so it doesn't really make sense to apply TOTEX rate making to expenditures that the utility just doesn't have any control over, like pensions that have already been set and the utility is already responsible for. Taxes would be another example. So there's a number of things that just the utility does not have a sufficient level of control over, and therefore shouldn't be included in TOTEX rate making. And so therefore it's included, but it's not included in the TOTEX allowance, and it instead is included in that adjustments box. The adjustments box also includes things like performance incentive payments, for example. Another note on the bottom there where it says depreciation expense, I assume everybody on this call is familiar with how that works currently. But under TOTEX rate making, just keep in mind that the TOTEX is being added, or rather slow money is being added to rate base. And so the depreciation is going to look a little bit different since there's no longer that distinction between individual projects with different lifetimes and rate base. It's all basically slow money. And how they handle this in the UK is that they apply an average asset lifetime to the rate base, the TOTEX rate base, and that's how depreciation is calculated and how the return of capital works in the Rio framework. Now, returning to that capitalization rate, what is that and where does that come from? So basically, TOTEX gets rid of Capex bias by removing the utility's ability to increase its rate base and therefore its profit by substituting Capex for OpEx. And it does that by basically mushing the two together and then recreating these slow money and fast money pots. And the capitalization rate is the number that is used to do that. It is set in advance, and then it is just applied to every dollar of Capex and OpEx that's controllable. You apply that rate. So in the UK, for example, the rate might be, for some utility, might be 80%. It varies by utility. It's set by the regulator, individually by utility. But let's say for a given utility, the regulator might expect that the efficient level of Capex in total expenditures is 80% for that utility. So therefore, the regulator will set the capitalization rate at 0.8. And if the utility spends $1 of Capex, that then becomes $1 of TOTEX. 80 cents of that dollar will become slow money and 20 cents will become fast money because of the 80% capitalization rate. Equivalently, if the utility spends $1 of OpEx, same thing happens, 80 cents of slow money and 20 cents of fast money. And certainly that capitalization rate is something that would need to be set, with an expectation of what that utility will need to really work efficiently. It's not really a plug and play reform. It's more of a choice that will need to be based on regulatory judgment and an assessment of what the spending needs actually are. Next slide. And if there are any clarifying questions, I'll defer to Commissioner Anthony on that, but feel free to interrupt me if you'd like to pause for any of those. Okay, so this is just showing side by side the two formulas that Cara and I just discussed, just so you can kind of compare and contrast a little bit before we move on. So up top there is the traditional formula with Capex bias being added to rate base and Capex being added to rate base and Capex bias arising from that. And on the bottom, you have TOTEX rate making, where slow money is being added to rate base and fast money is being passed through. Next slide. So we have been talking about TOTEX rate making as one component of a strategy to help keep rates affordable through the clean energy transition and just generally to enhance affordability. But it's really important, I think, to note at this stage that TOTEX rate making alone isn't necessarily going to help with affordability. It has to be paired with other reforms that also address a very closely related perverse incentive known as gold plating. And once again, most likely all of you are familiar with these two, but I'm going to step through them anyway, so we're on the same page. Capex bias is specifically fuel and purchase power. Good question. I'm seeing that in the chat. I will address that in just, I'll address that in a second. So Capex bias is specifically the incentive for the utility to substitute Capex for OpEx. Gold plating is simply the incentive to increase Capex under traditional regulation. So TOTEX rate making, what it does is it addresses Capex bias, but it does not address gold plating. It just kind of spreads the gold plating incentive equally over Capex and OpEx. So it doesn't make it worse, but it does not make it better either. Next slide. So basically, it's really important to think about ways to encourage cost control if the end goal is to really get the utility to pick the most cost-effective solution between CapEx and OpEx, and not just simply remove CapEx bias. So under RIO, TOTEX ratemaking addresses CapEx bias, while other components of the RIO framework incentivize cost containment. Two of these, and the most important, I would say, probably are a multi-year rate plan with a revenue cap, which sets the TOTEX allowance in advance so that the utility's actual spending decisions are not going to change the amount of revenues collected, and a TOTEX incentive mechanism, which basically is a type of performance incentive mechanism that allows the utility to keep a share of any savings it can achieve relative to its preset TOTEX allowance, and it also makes it bear the same share of any overspends. So there are other ways that you can also encourage cost control. These are not the only options, but some kind of measure to do that is important to really get that affordability benefit. Okay. I'm actually thinking maybe these both look like maybe kind of additional questions. So I'm just going to say maybe we should hold those for the discussion, but those are really good questions. So as Cara mentioned, we recently published a report, and this is it. And I don't know if we could maybe share the link to that report or if folks already have that, but this report primarily focused on whether TOTEX ratemaking was even feasible in the US. So we spent a lot of time looking, especially at US accounting standards. And within that, within GAP, the regulated operations topic, ASC 980, and looking at to see whether if you adopted TOTEX ratemaking, would you actually lose the ability to apply ASC 980? And also if that happened, would that create huge problems? Would the sky fall? Could utilities actually deal with it? And we conducted our research by talking to a range of different experts. And the key takeaway for us was that we don't think that TOTEX ratemaking, at least on its own, would be likely to cause problems with applying ASC 980. And also if it did happen for either TOTEX ratemaking reasons or kind of the reason that you just adopted a very broad PBR framework, if you actually did end up losing the ability to apply that, we actually think it would be manageable for the utility, but obviously not ideal. So those were our big takeaways. Just for reasons of time, I'm not going to go into all of the intricacies of how we reached those conclusions here, unless folks want to talk about it in the discussion, in which case we could do that. The report, though, does also address a few other questions about CapEx bias and TOTEX ratemaking implementation. And three of these are, you can see on this slide. So I'm going to walk through these briefly. One is whether TOTEX ratemaking itself would affect the utility's financial health. So in the report, we did look at, hey, what would happen if you have an accounting change? Would that have consequences for the financial health? And our answer to that was basically, we don't think so. But we also looked at what about the reform itself? And it's a major business model reform. So as you can probably anticipate, yeah, you would probably have some effects. It could affect the utility's credit rating. It could affect its cost of capital. But whether those impacts would be positive or negative is harder to say. And that would really depend on how TOTEX ratemaking was implemented in that jurisdiction. Second kind of broad question is whether adopting TOTEX ratemaking would actually alter the pace of decarbonization. And here the answer also is that it depends. In some cases, OpEx alternatives are going to offer greater decarbonization potential. For instance, energy efficiency tends to be a very cost-effective and oftentimes OpEx-based alternative to CapEx projects. And also through third-party clean energy portfolios, which include a variety of demand-side and supply-side clean resources, can be very cost-effective solutions that are OpEx from the utility's perspective. So for things like that, if you adopt TOTEX ratemaking by removing CapEx bias, that could help spur their adoption. However, renewable energy projects also tend to be very capital intensive. And under the IRA now, of course, the utilities, investor-owned utilities have, and municipal too for that matter, have more options to build and own those themselves cost effectively. So reducing CapEx bias, yes, it would also reduce the utilities' CapEx bias-based reasons to pursue big renewable projects. However, in this case, our recommendation is that rather than just keeping CapEx bias, or for that matter, any other perverse incentive around just because it happens to align with some policy goals, we'd suggest looking at ways to address that perverse incentive, ideally by removing it entirely, or at least by reducing its force, and then also in parallel adopt other PBR mechanisms that incentivize what we actually want rather than what that perverse incentive is doing. For instance, if the goal is decarbonization, it's not so much that we want more renewable infrastructure sitting around. What we really want is reduced carbon emissions, right? Potentially, there's other metrics you could use as well. But you could get a more cost-effective decarbonization outcome by then removing Capex bias, for instance, with TOTEX ratemaking, and also adopting, say, a PIM or some other PBR mechanism that rewards the utility for reducing its carbon emissions. The third question on here, would adopting TOTEX ratemaking make utility accounting more complex? This came up because we did talk to some experts who said, well, it's possible that the utility would have to keep another set of records for its state regulators if TOTEX ratemaking were adopted. And there's some precedent for this during the telecom deregulation, where some utilities were required to keep some additional records for state regulators. But I will note that the experts we talked to disagreed about whether this would happen. While some said, yeah, that could be a concern, others took the position of, well, this is really a rate-making treatment. It's not an accounting change at all. There's no need to keep another set of records. Other PBR mechanisms that get adopted, such as a index-based revenue cap under a multi-year rate plan, they don't require an accounting change. So there's no reason that TOTEX ratemaking would either. But it's something that this would need to be looked more into during proceedings if regulators choose to move forward with an investigation of TOTEX ratemaking in their jurisdictions. Next slide. And then I'm going to just really quickly step through these, and some of these align with some of the questions in the chat. So I think we can probably return to some of them during the Q&A after Jacob presents his slides. We also looked at these questions. What share of the utility's total cost should be included in TOTEX? Should regulatory assets and liabilities themselves be included in TOTEX? Should fuel costs be included in TOTEX? How can cost containment be encouraged? How should regulators set the amount of the TOTEX allowance? How should regulators set the TOTEX incentive rate? And that's the incentive rate for that incentive mechanism, the TIM. How should the capitalization rate be set? And also, should the allowed ROE be lowered if TOTEX ratemaking is implemented? And just that last one, just as by way of quick explanation, ROEs in general in the UK are lower, and that's where this question came up from. Basically, our conclusion on that one was no, there's no need to lower the ROE. If you adopt TOTEX ratemaking or vice versa, they're not really connected, but we go more into that in the report. And next slide. I think we can pass it off to our next presenter.
Hi, everyone. Can you see my screen? All right. So I want to start by saying I don't have a policy position on TOTEX. These slides are not designed to advocate for or against it. I'm just presenting the facts as I understand them. And what I have up here is a project I'm currently working on. It's rate making for a traditional cost of service utility. This follows the formula that was shown earlier. If you look here, it's what you're all familiar with, I assume. Capital expenditures get added to rate base. You get total rate base at year end times your rate of return. That's your return on rate base. OPEX and depreciation get added to that for your total revenue requirement. In this case of $9 billion, 9 million truncated here. This is for rate making purposes. When you follow this concept through to GAAP income reporting in the company's 10K, you would take your revenue minus your expenses, minus your interest expense to get your net income. So if they hit their numbers exactly, which never happens, obviously, but if they did, their net income would equal their return on equity. So if you take interest expense and net income, that's the return of capital from the prior slide. So the return on rate base was 2.2 billion. On their income statement, if you took interest expense and net income, you'd get $2.2 billion. So that's the general concept for traditional rate making in a very simplified, hopefully easy to follow format. When we look at TOTEX rate making, again, this chart is designed to follow what was just presented. You have the same numbers. So these numbers are consistent with both examples. You have capital expenditures of 3.2 and OPEX of 4.6. That gets added together to come up with a TOTEX amount of 7.8 billion. Now that gets divided up between slow money and fast money. I saw a question in the chat, which is a very good question. How do you set this? I think there's a lot that goes into that, but for purposes of example, I took 80% and 20% because I think it highlights what needs to be considered when you go through evaluating TOTEX as a rate making process. So in this example, we took existing rate base, added the slow money portion of 6.2 to get total rate base of 32 billion. Same rate of return. The return on rate base is 2.4. The depreciation is slightly higher because you're depreciating a higher rate base for your revenue requirement of, in this case, 6. So initial reaction is reduces the revenue requirement by quite a bit. But as we walk through later, there's trade-offs. It will come later in these slides and see what the implications of that are. So with that, I'll switch to ASC 980. So ASC 980 is an important consideration here. And this box on the left shows what the requirements are right from the FASB. So the first one is that you have to be regulated, which that will qualify. They're still going to be regulated entities. 2 is that they need to be cost of service regulated, meaning their cost of service is regulated and they get a return on that. So that concept still applies and is important. And the third one is that their rates are set and will be recovered from customers. So it seems simple, but the key considerations that will keep coming back throughout these slides, that must be cost of service regulated to qualify for ASC 980. And if they were to defer a substantial amount of costs and increase rate base by a lot, it will trigger additional consideration from their regulators. Similar to any concept, if a company has a large accounts receivable balance or a large deferred revenue or other assets that require collection, the auditor will give that extra scrutiny to make sure it truly will be recovered and it's being presented to shareholders and potential investors correctly. This slide here is from a public document from PricewaterhouseCoopers, and it goes to the factors that they consider in their interpretation of this guidance. And as they audit a lot of investor-owned utilities, I think it's important to consider how they view it. So the factors here are rate case activity. In order for a utility to qualify for ASC 980 treatment, the regulatory lag is not extensive. If the regulatory lag is extensive or unusually long, that may be a consideration whether or not they qualify for this accounting treatment. The second one is rate design. Are they designed to recover costs plus a reasonable return on rate base? This goes back to the cost of service concept. If they are, they can get ASC 980 treatment. If they're not, they potentially might not qualify for that treatment. The last one is cost uncertainty. And again, I saw a question in the chat around purchase power and other more unpredictable costs, which we'll get to in the Q&A. But the general concept is if highly volatile costs are addressed through another mechanism, this accounting standard is applicable to the utility. If they're not addressed through another mechanism, this accounting standard may not apply. So again, key considerations I would be thinking about if I were a regulator is 1, if rate base expands and gets to a high balance, which we'll see in an example later, does that constitute an unusually long lag period? Something to consider. Nobody knows the answer because it hasn't been tried yet, but important thought to consider. 2, will the return on rate base change under TOTEX? So are you going to keep it at 7.5%? Will it be higher? Will it be lower? And will this provide a reasonable return? Again, these are all subjective, judgmental determinations by the auditors and the company and their regulators on the financial side. And then 3, what costs will be included in TOTEX, and does this create uncertainty? Again, we'll get to this in the Q&A. Does it include purchase power or other unpredictable costs is an important consideration. So this, I put together this example. It's a bit extreme, but what it's trying to show is if a utility did not qualify for this accounting treatment under GAAP, what would their financial statements look like? So if you remember back to the slide detailing out how TOTEX revenue requirement was made, we're taking the revenue requirement of $6.5 billion minus the operating expenses, which get expensed as incurred in that period, minus the interest expense. So in this case, it'd be a pretty extreme outcome where they had to report a loss of $1.2 billion, which doesn't necessarily compare to the cash position or their ability to collect later, but it is important because this is what will get reported in their 10K to investors. The next slide coming up is a projection of what future rates would look like under traditional cost of service and TOTEX. Now, this uses some pretty broad assumptions that are important to understand because it drives the outcome. One is that the traditional cost of service assumes OPEX and CAPEX are going to grow at 3% each year. Optimistic that we'll get back to 3% of inflation eventually. The second assumption assumes that OPEX will grow 5%, but CAPEX remains consistent. The reason it's built this way is it's assuming this will incentivize cost to trend towards OPEX rather than CAPEX, which is one of the concepts that was described earlier. 3, the depreciation rate is held constant, and 4, the return is held constant. So that's 7.5%. So what you'll see, these numbers should look familiar. Year 1, traditional cost of service. You have total cost of 7.8, rate base of 29, revenue requirement of 9. TOTEX, same total cost, rate base is higher because you're putting more in rate base, you're putting OPEX in rate base, and a revenue requirement of 6.5. When you project these costs out 10 years using the assumptions I just walked through, this is what your rate base and revenue requirement would look like. So in both examples, your total cost is the same, 10.2 and 10.2. But what's happening for your revenue requirement is they're equal. Years after 10, the TOTEX rates would actually be higher because you're depreciating that larger rate base asset. And again, in year 10, the rate base under traditional cost of service is much lower because it's only including those capital costs. The rate base under TOTEX is significantly higher because it's including OPEX costs as well, which again eventually drives higher rates under the TOTEX model. So it's understanding the trade-offs of lower rates now versus potentially higher rates later. And again, I'm sure we'll get into this in the Q&A, how you set the capitalization rate, depreciation rates, et cetera, becomes incredibly important to understanding the implications for future rates. So some key considerations here. One is understanding whether short-term rate relief provided in a TOTEX model will offset future rate increases enough to justify that. 2, understanding that TOTEX may result in higher rate base balances. And if that happens, it could jeopardize ASC 980. So in this example I put together, which again is a bit extreme, by year 20, rate base under TOTEX is twice as much as rate base under traditional cost of service. And if that were to happen, it's very likely the utility auditors would be concerned about collectability and the lag around collectability. And that would raise questions around the GAAP accounting treatment in ASC 980. So with that, I put together some considerations that may be helpful for the folks participating in this call. I won't go through all of these. I think we either hit them throughout our presentations or we'll hit them in the Q&A, but these are some considerations that I think are important on this topic. So with that, in the interest of time, I will turn it back to Commissioner Anthony.
Oh, you're on mute, Commissioner.
Oh, I just thank you. Sorry about that. Thank you, Jake and Cara and Kaja. That was fantastic. I was hoping to start with just maybe a couple of like questions about how TOTEX works. And then I want to stop and give a little bit of time for anybody else to ask those sorts of questions about how it works. And then if I kind of want to get into more maybe like critical questions following once we all have gotten an understanding of how it works. But I'm just going to start with like a really, really basic question. What happens under a TOTEX regime between rate cases? Usually the utility eats any overspending of O&M between rate cases, and they get to keep the underspend. So does that fundamental model change in a TOTEX? How do you deal with that?
I guess I'll jump in unless you were asking that of somebody else.
No, everybody, please.
Okay, so there wouldn't necessarily be any change to that. I mean, in Rio, the revenue allowance is, it's a TOTEX allowance, so it's applying to both Capex and OPEX. So you could think of it equivalently to say if you adopted an MRP that did cover both Capex and OPEX without the TOTEX component being there. So yeah, the utility would still be responsible for managing its costs during the plan, and if it managed to achieve savings, then there would, if you had a TOTEX incentive mechanism in place, that would allow it to capture some of those savings and be responsible for some if it overspent, or if you had an ESM, same thing. And then at the end of the MRP, the regulator would come in and look at the spending and decide what to include or disallow at that point. So I'm not sure if that answers your question, but let me know if that's not quite it.